Something huge just happened in Shanghai on a regular Tuesday afternoon, and it might have just killed the US dollar as we know it. While everyone in the West was busy watching political drama and checking stock prices, China quietly flipped a switch that could change everything about how money works in the world. Here's what they did. The People's Bank of China just launched a brand new system that lets foreign countries take their Chinese yuan from trade deals and instantly convert them into actual physical gold bars at the Shanghai Gold Exchange. This isn't some future plan they're talking about. It's happening right now, today. And here's why this is absolutely massive. Nobody trusts the Chinese government. Everyone knows that. So China just found a brilliant way around that problem. They're basically saying, you don't need to trust us. Just trade with us using yuan, and if you don't like it, turn those yuan into gold immediately. It's like they created an oil for gold deal with the yuan just being the middle step. This is hands down the biggest threat to America's dollar dominance since 1971. And if you do understand what is happening, you're about to get financially destroyed. Let me explain why China's old strategy never worked. For years, experts kept saying China would make Saudi Arabia sell oil for yuan instead of dollars. But the Saudis always said no. Why? Think about it. Saudi Arabia's currency is tied to the US dollar. They depend on American military protection. And most importantly, what are they supposed to do with mountains of yuan? You can buy pretty much anything with dollars. With yuan, you can mainly just buy Chinese products or Chinese government bonds. Plus, China has super tight controls on moving money in and out of the country. And the Chinese government can change the rules whenever they feel like it. So holding massive amounts of yuan was way too risky for the Saudis. The yuan is like a trap. Easy to get in, but getting out? That's totally up to what the Chinese government decides that day. Now here's where the Shanghai Gold Exchange changes everything. China's new pitch to oil-producing countries like Saudi Arabia, Iran, Russia, and Venezuela is completely different now. They're saying, sell us your oil, we'll pay you in yuan. Don't trust the yuan? No problem. Within seconds, you can use that yuan to buy actual gold bars on our exchange. Then load that gold on a plane and fly it straight to Riyadh, Tehran, or Moscow. This basically creates a gold-backed digital currency for international trade. The yuan becomes just a temporary placeholder for gold. This solves the whole trust problem. The Saudis don't have to hold yuan and worry about China devaluing it. They hold yuan for maybe 5 minutes, then flip it into gold, the ultimate safe asset that everyone trusts. China gets the oil it desperately needs. The oil producers get the hard asset they want. And the US dollar gets completely cut out of the deal. This is what I call the golden loop. It lets China make its currency global without opening up its financial system. They don't need to let money flow freely in and out of China anymore. They just need to let gold flow out. This whole mechanism is the result of over 10 years of China aggressively hoarding gold. Since 2008, China has been both the world's biggest gold producer and the world's biggest gold importer. But here's the key difference from Western countries. China almost never exports gold. Whatever gold goes into China stays there permanently. The People's Bank of China has been systematically selling U.S. Treasury bonds and buying gold instead. In just 2023 and 2024, they officially added hundreds of tons to their reserves. But most experts think their secret purchases are 10 times higher than what they're reporting. They're hiding gold in sovereign wealth funds and military accounts. They've been building up this gold war chest for exactly this moment. They understood that to challenge the dollar, you need more than just a big economy. You need something people can trust. The U.S. has the full faith and credit of the U.S. government. China has actual gold bars. And in today's world of crazy inflation and countries using sanctions as weapons, gold is a way stronger foundation than just faith and promises. The timing of this move is no accident. This creates a massive problem in the global bond market. Something called Gresham's Law. This law basically says bad money pushes out good money. If the world has two reserve currencies, one backed by debt and inflation, the dollar, and one backed by gold convertibility, the yuan, countries will spend the bad money and save the good money. We're already seeing this happen. Central banks around the world are selling U.S. treasuries, spending the bad money to buy gold, hoarding the good money. This is why interest rates on U.S. debt keep going up. The foreign central banks that used to buy our bonds are leaving the market. This forces the Federal Reserve to become the buyer of last resort. The Fed has to print money to buy the bonds that China and Saudi Arabia refuse to buy anymore. This money printing causes inflation in America. So this gold yuan mechanism basically becomes an inflation export machine working in reverse. It forces the U.S. to absorb its own inflation instead of exporting it to the world like they've been doing for 50 years through the petrodollar system. For 5 decades, America exported its inflation. Now the flow is reversing, but there's more. This move is about to expose a massive fraud in the Western gold market. The price of gold in London and New York is mostly determined by trading futures contracts, basically paper promises to deliver gold later. The volume of paper gold being traded is often 100 times more than the actual physical gold that exists. It's a fractional reserve system built on promises. But the Shanghai Gold Exchange is different. It only deals in physical metal, cash and carry. You're trading actual gold bars, not paper promises. As this golden loop activates, massive amounts of real physical gold are getting sucked out of the West and shipped to the East to satisfy trade settlement demands. This is draining the vaults in London and New York. Eventually, the whole leveraged paper system in the West will break down. When there's no physical gold left to deliver against those futures contracts, the price of paper gold and physical gold will split apart. Physical gold will trade at a huge premium. This is the market default scenario that gold investors have been warning about for decades. China is basically orchestrating a slow-motion bank run on Western gold banks. By offering instant convertibility, they're calling the bluff of the fractional reserve system. This isn't just an economic move. It's a geopolitical checkmate. This aligns China with all the resource-rich countries of the global south, the BRICS nations and beyond. These BRICS countries control most of the world's oil, natural gas, rare earth minerals, and food production. Meanwhile, the G7 nations control most of the world's financial derivatives and debt. Here's the thing, in a real conflict, you can't eat derivatives. You can't fuel a military tank with debt. China is betting that real physical things, commodities, matter way more than financial things like fiat currency. By linking their trade currency to the ultimate real asset, gold, they're basically creating a commodity-backed standard. They're sending a clear message: the era of financialization, where money magically makes more money, is over. The era of production, where resources equal power, is back. The activation of this Shanghai mechanism is the starting gun for revaluing all hard assets against all fiat currencies. The dollar isn't really collapsing against the euro or the yen. It's collapsing against oil, gold, copper, and energy. The yuan is just the pipeline for this repricing. Now, to the average American shopper, this monetary decoupling happening in Shanghai might sound like some abstract game played by bureaucrats in fancy offices. But economic reality doesn't care about what you think. What's happening at the Shanghai Gold Exchange will eventually show up at your local Walmart checkout. The activation of this gold yuan settlement loop is reversing a system that subsidized the American lifestyle for 50 years. It's called Triffin's Dilemma. For decades, the United States had an incredible privilege. We could print unlimited dollars to buy real stuff. Cars from Japan, oil from Saudi Arabia, electronics from China. Then those countries would take those dollars and invest them back into U.S. Treasury bonds, basically lending us the money back at low interest so we could buy even more of their products. It was the ultimate free lunch. We got the goods. They got paper promises. The Shanghai mechanism breaks this cycle completely. If China, Brazil, and Saudi Arabia aren't recycling their trade surpluses into U.S. treasuries anymore, if they're converting those surpluses into physical gold instead, then who's left to fund America's massive deficit? The answer is nobody except the Federal Reserve. This triggers what's called the bifurcation of prices. We're heading toward a world with 2 different price tags for everything. Price A is the gold price. This is what countries in the yuan zone pay, the BRICS nations and allies. Because their currency is backed by or convertible into gold, they get a discount. They're trading real value for real value. Price B is the dollar price. This is what the G7 countries pay. Because the dollar isn't the undisputed king anymore, sellers will charge a risk premium to accept it. So if you want to buy Saudi oil with US dollars, you might pay $100 per barrel. If you want to buy it with gold convertible yuan, you might effectively pay $80. This built-in disadvantage means America will start importing permanent, structural inflation. We're used to temporary inflation when the economy is running hot. What's coming is currency debasement inflation. Prices go up because sellers don't want your paper money anymore. This leads to what I call the inventory crisis. For 30 years, the U.S. economy has run on just-in-time supply chains, optimized for maximum efficiency and minimum inventory. This model assumed the dollar was a golden ticket that could buy anything anytime from anywhere. But in this new split world, supply chains become just in case. Countries that actually make physical things will stop accepting rapidly depreciating fiat currency. We're already seeing this. India banned rice exports. Indonesia banned nickel or exports. They're realizing that in an inflationary world, keeping the inventory is worth more than accepting cash. For American consumers, this shows up as random shortages. You go to the hardware store and copper wire is out of stock. You go to the pharmacy and basic antibiotics are backordered. It's not because factories stopped producing. It's because the products are flowing to buyers paying in hard money, gold, commodities, instead of soft money like dollars. The U.S. is slowly moving from the front of the line to the back. But the most dangerous feedback loop is happening in the U.S. Treasury market. As the Global South exits the Treasury market to move into the Shanghai gold loop, American interest rates lose their anchor. Foreign central banks own about $7 trillion of U.S. debt. If they sell even just 10% of that to buy gold, that floods the market with $700 billion of bonds. When everyone's selling bonds, interest rates spike. In a normal free market, U.S. interest rates would jump to 8%, 10%, maybe 12% to attract new buyers. But the U.S. government is $36 trillion in debt. It absolutely cannot afford 10% interest rates. The interest payments alone would eat up 100% of tax revenue. So the Federal Reserve is forced into something called yield curve control. This is the end game. The Fed will basically declare, we will not let the 10-year Treasury yield go above 4.5%. To enforce this promise, they have to print money to buy every single bond that China and Saudi Arabia sell. They become the world's bad bank, absorbing all the toxic debt that everyone else is rejecting. This money printing operation causes hyperinflationary meltdown. The more foreigners sell, the more the Fed prints. The more the Fed prints, the more the dollar loses value. The more the dollar loses value, the more foreigners sell. It's a death spiral that ends with the dollar completely losing its reserve currency status. The domestic consequence of this is what I call the Latin Americanization of the U.S. economy. In countries like Argentina or Brazil, the upper class doesn't hold local currency. They hold dollars or gold. But the middle class gets trapped in local currency and gets destroyed by inflation. We're seeing this exact dynamic starting in the U.S. Wealthy people are buying farmland, art, gold, and Bitcoin. They're exiting the dollar. Meanwhile, working-class people are holding cash and getting crushed by a rising cost of living. The Shanghai Gold benchmark is basically the scoreboard showing you how much wealth is being transferred from the U.S. middle class to commodity producers in the East. Every time the gold price in Shanghai ticks up, it's a signal that the dollar's buying power has ticked down. The gold price isn't just a trading number. It's literally the inverse of the Faith in America number. This shift also exposes the paper derivative bubble in Western banks. The U.S. banking system holds trillions of dollars in interest rate derivatives and swaps. These are bets based on the assumption that interest rates will stay stable and low. If the Shanghai mechanism forces U.S. rates to rise or forces the Fed to print endlessly to keep them low, the volatility will blow up these derivative positions. We saw a preview with the Silicon Valley Bank collapse. That was a tiny tremor from rising rates. The Shanghai shock would be a full earthquake. If the global south stops buying U.S. debt, the volatility suppression that's kept Western markets calm for 20 years ends. We enter a period of high volatility and high inflation simultaneously. This is the worst possible environment for the standard 60/40ths portfolio to 60% stocks, 40% bonds. Both stocks and bonds fall in real purchasing power during this phase. The only assets that survive are those with zero counterparty risk, exactly the assets that the Shanghai Exchange is prioritizing. Finally, we have to consider the geopolitical response. The United States will not let its dominance die without a fight. Historically, when a reserve currency gets challenged, empires respond with capital controls and tariffs. We should expect the U.S. to make it much harder for capital to leave the country. Exit taxes will increase. The government might restrict how much gold or Bitcoin you can buy. They'll frame it as fighting money laundering or protecting national security. But the real goal is to trap money inside the U.S. system, to force you to buy the treasuries that China is refusing to buy. This is called financial repression. The Shanghai Gold Exchange offers a fire exit for nations. Individual investors need to find their own personal fire exit before capital controls slam the door shut. The existence of a working, liquid, gold-backed alternative to the dollar is the catalyst forcing the U.S. to turn inward and become more authoritarian with its own capital markets. The free market era of globalization is officially dead. We're now in the era of fortress economics, where capital is weaponized and gold is the only neutral ground left. The activation of this Shanghai gold loop isn't just a trade mechanism. It's the final signal that the world is transitioning from credit-based money to bearer asset money. For the last 50 years, wealth was defined by liabilities. If you had $1 million in the bank, what you actually had was $1 million promise owed to you by the bank. If you owned a treasury bond, you owned a promise from the U.S. government. The entire system relied on the counterparty keeping their word. But the Shanghai mechanism explicitly prioritizes assets with no counterparty, physical gold. This shift from promises to actual physical atoms will unleash the greatest wealth redistribution in human history, specifically punishing people who hold their life savings in promises from G7 nations. The most dangerous trap facing American investors right now is the DXY trap. The DXY is the US dollar index, which measures dollar strength against other currencies like the euro, yen, and British pound. You'll hear financial experts say, "The dollar is strong. Look at the DXY. This is a fatal distraction." The euro and yen are also fiat currencies drowning in debt. Measuring the dollar against the euro is like measuring which of two people is taller while they both drowning. One might be slightly taller, but both are underwater. The Shanghai Gold Exchange doesn't care about the DXY. It measures the dollar against gold. Against gold, the dollar has lost 98% of its purchasing power since 1971. The Shanghai shock will accelerate this collapse. As the global south dumps dollars to buy gold, the dollar's domestic purchasing power will collapse, even if the DXY stays high. We could see a situation where the dollar rises against the euro because Europe is collapsing faster, but a gallon of milk in New York costs $15. This is stagflationary collapse. The currency looks strong on forex charts but buys nothing in the real world. This brings us to the absolute necessity of outside money. In financial theory, inside money is an asset that's someone else's liability, bank deposits, bonds, cash. Outside money is an asset that's nobody's liability. It exists independently of the system. Gold is classic outside money. But in the digital age, we have a second form, Bitcoin. The Shanghai mechanism actually validates the Bitcoin thesis. Why? Because Bitcoin is basically digital gold that can be teleported instantly. If China wants to settle a trade with Brazil without using the U.S. banking system, they can ship physical gold, slow and expensive, or they can send Bitcoin, instant and final. The U.S. government can block a Bitcoin transaction between two sovereign nations any more than they can intercept a gold shipment mid-flight. As the golden loop gains momentum, we'll see gold advocates and Bitcoin believers converge. They're fighting the same war against the same enemy, counterparty risk. The 60/40th portfolio of the future won't be stocks and bonds. It'll be productive assets, stocks, real estate, and outside money, gold, Bitcoin. The bond allocation will go to zero because bonds are the assets of the dying regime. However, individual investors must watch out for the paper trap in commodities. Just like the Shanghai Exchange is exposing the fractional reserve nature of the COMEX gold market, paper traps exist everywhere. If you own a gold ETF exchange-traded fund, do you own gold? No, you own a share in a trust that claims to hold gold. In a systemic crisis where physical inventory gets drained by the East, the ETF might declare force majeure. They might settle your claim in cash, depreciated dollars, rather than actual metal. You miss the upside completely. The lesson from Shanghai is self-custody. If you don't physically hold it, you don't own it. This applies to Bitcoin too. If your coins are on Coinbase or Binance, they're inside money. They're a liability of the exchange. If the government imposes capital controls to stop wealth flight, they'll seize centralized exchanges first. You must hold the private keys. You must hold the physical coins or bars. The Shanghai shift is a return to bearer assets where possession is the only law that matters. We also need to consider the silver squeeze. Gold is the money of kings and central banks. It's high value density. Silver is the money of regular people. It's also a critical industrial metal for solar panels, electronics, and batteries. The Shanghai mechanism affects silver too. As gold becomes unaffordable, priced into the stratosphere by central bank buying, regular people will panic into silver. Historically, the gold-to-silver ratio averages around 15:1 or 20:1. Currently, it's often around 80:1. This suggests silver is historically undervalued. If the industrial supply chain breaks, the inventory crisis I mentioned, and simultaneously monetary demand spikes, silver could see a vertical price explosion that dwarfs gold in percentage terms. It's the highly leveraged play on the collapse of the fiat system. The geopolitical response to all this will likely be rolling out central bank digital currencies, CBDCs, in the West, as the U.S. loses control of the international settlement layer because of Shanghai. They'll try to tighten control of the domestic settlement layer. They'll say, to protect the economy from foreign manipulation, we're introducing the digital dollar. This allows them to implement negative interest rates and programmable money. They can force you to spend your tokens to stimulate the economy. They can prevent you from buying or hoarding assets like gold or ammunition. The CBDC is the anti-gold. Gold is anonymous, permanent, and free. The CBDC is surveilled, temporary, and controlled. The battle lines of the next decade will be drawn between the Shanghai bloc, hard assets, sovereignty, and the CBDC bloc, fiat control. You, as a citizen, will have to choose which economy you want to operate in. Operating in the Shanghai bloc holding gold, Bitcoin, will likely be made difficult or illegal by Western governments. They'll use capital gains taxes or windfall taxes to try to confiscate the gains you make from holding real money. This is why privacy and jurisdictional arbitrage, having a backup passport, become financial assets themselves. The Shanghai gold benchmark is the bell ringing at the top of the market for the American empire model. It signals that the special privilege of printing money to buy oil is over. For 50 years, life in America was artificially cheap because the rest of the world subsidized it. Now the bill is coming due. The cost of living will rise to reflect the true value of the dollar, not the artificial value propped up by the petrodollar system. This will result in a lower standard of living for the vast majority of the Western population. But for the minority who understand what is happening, the ones who swap their paper for metal and code before the panic starts, this is an opportunity to preserve generational wealth. The window to exchange fake money, overvalued dollars, for real money, undervalued gold, land, Bitcoin, is closing fast. The Shanghai Exchange is open. The drain has begun. Don't be left holding the empty bag when the vault is finally declared empty.